Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to talk about capital allocation. And within capital allocation, I want to focus mainly on dividend payment and share repurchases. This is going to be a series of probably 4 or 5 videos in which I'm going to show you different levels of analysis. I'm going to start with a discussion of Warren Buffett in his letter of 2012 about dividend payment. He uses an example to illustrate, and I'm going to replicate that example. I'm going to show it to you in the first video, and later on I'm going to show you other work based on this same work that Buffett published, and it's going to give us an understanding about the dividend payment and the share repurchases and the way that management should go along on the capital decision making, specifically when distributing cash to shareholders. So let's get to it. So in the capital allocation decision making process, we have the sources of funds need to be allocated intelligently in a way to maximize value creation for the long run in the company. So the sources of funds could be issuing equity, raising debt, the cash generated by the business, or proceeds from sales of businesses. And the uses of funds could be to reinvest in the business, reduce debt, make acquisitions, or pay dividends and repurchase stocks, which are ways to distribute capital to shareholders, or even retain the cash in the business and build up the balance to use it in the future. This video is going to be a series of 4 or 5 videos in which we will be discussing different portions of these two aspects of the capital allocation decision making. And you'll see that by the end of the series, I think that the payment of the dividend and repurchase of stock, I think, will be seen in the same light as the making of an acquisition or the reinvestment of the business. Really, there is no difference. And I will start the analysis by showing you a discussion that Warren Buffett goes through in the shareholder letter of 2012, where he says that he thinks that shareholders of Berkshire are better off because he used the funds for acquisitions instead of having devoted them to share repurchases or dividends. And he goes to explain in an example, a mathematical example, which is a little bit tedious, but I'm going to try to show it to you here. So he says, we are starting with a company of 2 million net worth, let's assume. And let's assume that the company is earning a return on equity of 12%. So the earnings are going to be 240. 2 million times 12%, 240 every year. Then the market pays 125% of the net worth of the business. Therefore, the market value of the company is going to be 2.5 million. Here he's talking about 1.25 million because he's talking about 2 shareholders, and I'm talking about the whole company. So this means that price to book is 1.25 times. And if you see here, book value, equity, or net worth are all different names of the same thing. So then he says that they want to distribute $80,000 in dividends. That means 1/3 of the earnings. And they want to reinvest the other 2/3 into the business. And they will be reinvested at 12% of return as well. So he keeps saying that in total the dividends and the stock value would increase at 8% each year, and this is because you are reinvesting only 2/3, meaning 8% of the 12%, and this is how it's going to grow the net worth. 160 of 2 million is 8%, and earnings are going to grow as well at 8%. Next year, market value is going to grow at 8%. Everything is going to grow at 8% year after year after year. So what happens is that in year 10, after 10 years, the net worth is going to be 4.3 million, which is the original 2 million compounded at an 8% per year. The dividend is going to be 172,000, which is this 86 times 2. which is also the growth of 8% over 10 years. And the net worth of shareholders is going to be 5.4, which is 125% of this. And then we would live happily ever after, because our dividends are growing at 8% and our net worth is growing at 8%, everybody's happy. But then he says there is an alternative approach in which we reinvest the 240,000, all of it, into the business. And then we manufacture, let's say, a dividend by selling 3.2% of the company in the first year, which is 3.2% of 2.5 million is 80. This is the sell-off approach. So in essence, we reinvest everything, which is what he has been doing, instead of paying back a dividend. And then those that would have wanted to get some funds from the company, they could have manufactured these dividends by selling stock at the 1.25% price to book. So if we do that for 10 years, in year 10, at the end of the period, the net worth would have grown to 6.2 million. That means 2 million compounded at 12%. And now the compounding is 12% because you reinvest everything. And of course, everything grows at 12%, except the sell-off, because the dividend will grow at 8% only. But then you will have to sell a percentage. You will end up owing 73% of the company, because you would have sold 27% during those 10 years. So 73% will mean 5.6 million of net worth, which is 2.8 times 2, which is 4% greater than this other option that we saw a minute ago, which is 5.4. In the dividends scenario, 5.4 was the net worth, and the dividend stream was the same, because we have manufactured exactly the same dividend streams. So you see here that in this scenario, they are better off. The original shareholders are better off, even though they have to sell part of the business, because the business has been increasing much faster. They will be better off. So this calculation, of course, assumes that our hypothetical company can earn an average of 12% annually on net worth, and that its shareholders can sell their shares for an average of 125% of book value. And Buffett says that to that point, the Standard & Poor's earns considerably more than this and sells at a higher price than this. And both assumptions, 12% and 125, are also reasonable for Berkshire. So he thinks that Berkshire shareholders, because this is the situation of Berkshire, roughly, or very similar, are better off. So if we go back to the slide about capital allocation decision making, the payment of the dividend is not necessarily a straightforward decision, and it not always makes sense. This is what was shown by Mr. Buffett. So in this case, where return on equity is 12%, meaning that the management can reinvest in the business or make acquisitions at the 12%, and shareholders can sell their stock at the price to book of 125. In this case, payment of dividend is not the preferable solution for shareholders. Of course, it all depends on this relationship of these two numbers. And what I did was I started playing with these numbers in a spreadsheet. I replicated Mr. Buffett's example, and I started playing with these two different numbers, and I found some interesting relationships and interesting implications in the whether dividend payment or sell-off alternative is the best. I think management should keep that in mind when making that decision. It is another ingredient as well for us to check whether management is undertaking their decision-making process in the way that suits the shareholders and the value creation of the company the best. So I hope that you like this video. Please give it a like if you do. And thanks very much for watching. I'll see you in the next video. Bye bye.